Today, I will be talking about a simple strategy that consists of just 3 exponential moving averages. This is a scalping strategy that allows you to often get quite accurate signals. So what is scalping? It is a type of trading when trades are open frequently and on low time frames. The time frame, I will remind you, is the scale of the candle on the chart. That is, if we now have a 15-minute time frame set on the Bitcoin chart, it means that each candle shows us the result of trading for 15 minutes. We can specify the scale that we need, for example, 5 minutes. For this strategy with 3 slides, we will need a 5-minute time frame. Now we see the graph larger, it is the same graph, only enlarged. Now each of the candles shows a time interval of 5 minutes. So scalping is good because firstly, it gives very accurate signals, and secondly, due to the fact that we work on low time frames, the signals will appear quite often. So let's look at the main elements of our strategy. It consists of 3 exponential moving averages. When you calculate the exponential average, it reacts to price a little more sharply and a little more flexibly. And that's why we get a signal earlier than we would if we were using regular moving averages. In general, the strategy consists of 3 sliding bands with different periods. This strategy is very similar to Bill Williams' classic hour alligator indicator. But unlike Bill Williams' alligator, our strategy is more tailored to today's markets. Here the sliding periods have been changed, and it works out much more accurately. Let's move on to customizing the indicators. We need to set up 3 exponential moving average indicators. To do this, we go to the Tools, Selection menu, Technical Indicators, and write Moving Average Exponential. We put 3 pieces on the chart, and now we need to change their periods. The first moving average will be the fastest with a period of 25. It will show the average value over 25 candles. We're making it red in color. It's more sensitive, it's faster. It looks pretty similar to the way the graph behaves. The next moving average will have a period of 50. It shows the average value for 50 candles, and we will make it green. We change colors to make the lines visually different. As you can see, the green moving average reacts more slowly to the chart and smooths out its movement. And set the third moving average in blue color and set its value to 100. She'll be the slowest. Now we are ready to open trades with this strategy. So, in order to open a trade, we first need to find a clear trend. How do you figure that out? During a trend, the highs are constantly updating each other, there is constant movement. And during consolidation zones, it is not clear exactly where the chart is going. First up, then down, up again, down again, and so on. Also, the slides themselves suggest where there is a local trend and where there is not. For example, there was a local trend for a short period of time, but here now the consolidation zone and the lines are tied together. When the lines tangle with each other, we do not open trades. Let's move on to examples of charts on which to open trades. For example, here we see a clear uptrend. It's a far growing trend. We need to look for just such moments on the moving lines. They suggest that the trend is upward because they are not mixed up with each other. As you can see, they were mixed up before, but are currently pointing to a trend. ONE are arranged in the following order: red, green, blue. This means the trend is upward. What are the signals to enter a trade here? When our chart, for example, is on this area, i.e., crosses the red fastest line, then we open a trade up. Next, if the chart continues to go down and reaches the green line, we open a second trade up. So we look for when the trend has corrections, and on those corrections, we buy at more favorable prices, continuing the overall trend. So let's see how many times we could use our strategy here. Here the trend has started. We got a signal from the moving average. Here the chart crosses the red line. We enter the trade. And here we can already see that the chart is rising and we are making a profit. Then the correction occurs again. The red line crosses, the green line crosses, the chart regrows again. We take profits again. Here, as you can see, some volatility happened. The chart crossed both red and green at once. We can open 2 trades here, and after this chart, we will close both of these trades with a profit, and so on. If we look further down the same trend, we see that right here, as the trend started to fade, we could have opened a trade here and a trade on the green line. But over time, both of these trades would have gone into positive territory, and we would still have made a profit on them. Now let's talk about how to exit trades. I recommend that on each of these trades, when we place a stop loss, we place it at the level of the blue line. And in this case, even if we hit a trend reversal, the end of the trend, we will have a stop triggered and we will not lose a lot of money. It's like a kind of insurance. You can use a strategy called trading stop. That is, you could open the first trade here and set the stop here. And as the chart grows, move the stop following the blue line. In this case, sooner or later, for example, in this moment, your stop level would be higher than the entry price, and you would close the deal in any case in a plus. Either you can use a fixed stop and open new trades every time, or put one stop loss and just move it following the chart growth. Another important point, when the chart crosses the blue line, no matter if there were trades at that moment or not, we no longer use this chart to look for trades up and wait for new signals from our indicator. See, the lines are intertwined here, and according to the rules of strategy, when the lines are intertwined with each other, we can't use them for our strategy. Let's look at another example on the graph. This is already an example of a downtrend. The logic here is the same. We are waiting for a trend signal to appear, that the lines go up and are not mixed up with each other. Here the downtrend is indicated by the fact that the order of the lines is first blue, then green, then red. That is, the red line, which reacts the fastest on the chart, is below the others. And visually, you can see here that a clear downtrend is taking place. So, we have a signal emerging here. Watch it work out. First, there's a very strong trend. There's a crossing of the red line. We enter a trade. There's a crossing of the green line. We enter a second trade, and the chart continues to fall. And here, we calmly close both deals with profit. Then we see another correction. We enter two trades again, and in time, somewhere by this point, we are already exiting this trade with a profit, and so on. Next, we see that the trend is still continuing. We could use this area to enter the trades and make profit on them as well. Then we see that again, the red-green line is touched. Again, we close the trade down and again get profit on it, and so on, until the chart crosses the blue line. This is what happened right here. It doesn't matter if there were trades here or not. Here we would have to go out on a stop and lock in all the profits we made from the entire long trend. So let's repeat once again all the tips. First, as I said, always check the time frame to make sure it is 5 minutes. Second, always follow a strategy. Always set a stop in order to control risk, and try to pick as accurate trends as possible. During consolidation periods, the strategy does not work well. It needs new movements. I hope this strategy will help you in profitable trading. Share why.